$1 million portfolio sitting in a broad market index fund generates about $70,000 of growth in its first year alone, on average, just by existing. That's not a contribution to it from your paycheck, not a withdrawal you can take. That's the inflation-adjusted compound growth the portfolio creates on its own, while you sleep. The number is meaningful because it's roughly the median post-tax household income in the United States. Your portfolio is now earning, in real terms, what a typical American family takes home from showing up to work all year. That changes a lot of things about how you should think about money, how your career fits into the picture, and what the actual point of saving was. Most people frame $1 million as the end of their wealth journey. It's actually the start of a completely different one, governed by different math and different decisions. This video walks through the 5 most important things that change once you cross the 7-figure threshold, the math behind each, and what people who have actually crossed it do differently from people who haven't. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people, instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that's what you want, hit subscribe. The reason I'm framing $1 million as a rule rather than just a number is that crossing the threshold genuinely changes the rules of the game you're playing. The strategies that got you from $0 to $1 million, mostly aggressive saving and disciplined contributions, become less important after. New strategies, mostly around tax optimization, asset allocation, and behavioral discipline, become more important. Most people who cross $1 million are still playing by the rules of the earlier game, which leaves significant value on the table. Change 1. Your portfolio out-earns most jobs. The first change is the one that flips the basic identity of where your money comes from. At $1 million portfolio invested at a 7% real return, the annual compound growth in the first year is $70,000. To put that in context against individual wages rather than household income, per Bureau of Labor Statistics data from the first quarter of 2026, median weekly earnings for full-time U.S. wage and salary workers were $1,215, or about $63,000 a year before taxes. A single full-time worker at the median earns less from their paycheck than $1 million portfolio earns from compound growth. The portfolio out-earns the worker. The implication for someone who has just crossed $1 million is psychologically larger than the numerical change suggests. Up to that point, your savings were the source of your wealth building. Your paycheck did the work, and your portfolio was a downstream effect. After crossing $1 million, the relationship inverts. Your portfolio does most of the wealth building, and your paycheck is supplementary to it. The amount of money flowing into your net worth from your continued contributions becomes smaller than the amount flowing in from the portfolio's compound growth, even if your salary doesn't change. My neighbor Paul is a good example of what this looks like in practice. Paul retired at 54 with a $1.4 million portfolio, mostly in broad market index funds. He'd been a state government employee his entire career, with a peak salary that never exceeded $58,000. He drives a 2003 Subaru Outback that's still running fine. His portfolio at 7% real return generates roughly $98,000 a year of compound growth on its own. That's substantially more than his peak working salary ever was. The day Paul realized that his portfolio was earning more annually than he ever did at work was the day he started seriously thinking about retiring. The math had silently switched sides on him. There's something specific that happens when this realization lands. Most people have spent their entire adult lives understanding that wealth comes from labor. You work, you get paid, you save what you can. The flow of money has always run from job to bank account. The moment your portfolio starts producing more than your paycheck does, The direction of that flow inverts in a way that's genuinely disorienting for the first few years. The portfolio becomes the senior partner in your financial life, and your career becomes the junior contributor. People who recognize this shift early adapt their identity around it. Those who don't keep treating the portfolio as a side note to their working income and miss the leverage they've earned through decades of disciplined saving. Change 2. The doubling clock changes dramatically. The second change is about how fast the second million arrives compared to the first. The journey from $0 to $1 million takes most middle-class households somewhere between 20 and 35 years, depending on income, savings rate, and starting point. At a 7% real return, even with no further contributions, a $1 million portfolio doubles to $2 million in about 10 years. Let that sink in. The first million is a multi-decade project. The second million arrives in roughly 10 years, passively, even if you stop contributing entirely. If you continue to contribute at any meaningful rate, the second million arrives a bit faster. Contributing $1,000 a month from age 50, when many disciplined savers cross $1 million, gets you to $2 million by about age 60, instead of around age 61 with no contributions. The compound clock is running so much faster at this balance level that contributions become almost an accelerant rather than the main engine. This is the math behind why so many people who have been disciplined savers their entire lives suddenly find themselves with much more wealth than they ever planned for in their early 60s. They were running their saving rate based on what got them through the first million. They didn't recalibrate when the math fundamentally changed. The portfolio's growth alone was outrunning their planning assumptions by a factor of 3 or 4 times annually. The doubling clock has a second implication worth flagging. It changes what counts as a big year or a bad year for your wealth. Below $1 million, a 20% market drop on a $500,000 portfolio costs you $100,000, which feels enormous because it represents many years of personal saving. Above $1 million, that same 20% drop costs $200,000 on a $1 million portfolio, which is even larger in absolute terms, but represents a much smaller share of your total path forward, because the recovery from that drop happens passively as compound resumes its work. The emotional weight of market volatility decreases at higher balances, even as the dollar volatility increases, because the compound engine is doing enough work that drawdowns are background noise rather than existential threats. Change 3. Your career becomes optional. The third change is the one that often takes the longest to internalize emotionally, even though it happens mathematically the day you cross the threshold. At $1 million, you have enough invested capital to generate about $40,000 a year of safe withdrawal income at the 4% rule that William Bengen established in his 1994 research, or about $47,000 a year at the updated 4.7% safe max rate Bengen published in his 2025 research after rerunning approximately 400 historical retirement scenarios. Bengen himself has suggested that many retirees today could safely withdraw between 5.25 and 5.5% without significantly increasing the risk of running out of money. For a single income household, that level of safe withdrawal, combined with eventual Social Security of roughly $25,000 a year, comes within striking distance of the median US household's actual cost of living. What this means practically is that someone with $1 million saved who continues to work is no longer doing it because they have to. They're doing it because they want to, or because they want a higher retirement income than $40,000 to $50,000 plus Social Security would provide. The decision to continue working becomes a real choice rather than a structural necessity. That doesn't mean everyone should retire at $1 million. Most people genuinely don't want to retire in their 40s or 50s on a $40,000 to $50,000 income. But the freedom to refuse a bad job, push back against an unreasonable boss, take a sabbatical, change careers, or start a business is real in a way it isn't for someone with $200,000 saved who still needs the paycheck to cover their fixed costs. Paul described the feeling as the day I realized I didn't have to ask permission anymore. He didn't quit immediately. He kept working another 2 years, but the way he engaged with his job changed completely. He took the projects he found interesting, said no to the ones he didn't, stopped taking work home, and stopped tolerating the parts of office politics he had previously absorbed silently. The portfolio gave him a kind of structural confidence that no amount of personal courage could have produced on its own. This is the practical reality of what people sometimes call FU money, though that label undersells what's actually happening. The financial cushion doesn't just give you the ability to walk away from a job, it changes how the job feels while you're still in it. You no longer have to swallow the bad parts to keep the paycheck. You're free to be the version of yourself you'd be if money weren't a constraint, which often turns out to be a more honest, more direct, and ironically more valuable version of you to your employer. Some of the most successful late career professionals I know hit their peak earning years not before they had enough money to walk away, but after, because the optionality made them more willing to push back, take risks, and demand fair compensation. Change 4. Asset allocation starts mattering more than savings rate. The fourth change is mathematical, and it's one most people miss because they keep optimizing the same lever they always optimized. Before $1 million, the highest leverage variable in your wealth building is your savings rate. Saving an extra $5,000 a year on a $200,000 portfolio adds $5,000 to the wealth engine, which is meaningful relative to the $14,000 the portfolio generates on its own at 7% real return. The savings dwarfs the compound contribution at small balances. After $1 million, that ratio inverts. Saving an extra $5,000 a year on $1 million portfolio adds $5,000 to a wealth engine that already generates $70,000 on its own. The savings is now a small fraction of the compound contribution. What matters much more is whether the $70,000 comes in at 7% real return, or 5%, or 9%, because that variable now drives most of the outcome. A 2 percentage point swing in expected return on $1 million portfolio changes annual growth by $20,000 a year. To get that same $20,000 of additional growth through savings rate alone would require saving an extra $20,000 a year on top of what you're already saving, which for most households at this balance level is barely possible. The implication is that asset allocation, expense ratios, account structure, and tax efficiency become disproportionately important after $1 million. The mechanical things you can do to capture an extra 0.5% of return per year on $1 million portfolio generate $5,000 a year of additional wealth compounded forward, which exceeds what most households can add through additional savings at this stage. The lesson is to shift attention from how do I save more to how is what I have invested. The specific decisions that move the needle at this stage look different from earlier stage decisions. The choice between a target date fund with a 0.6% expense ratio and a 3-fund portfolio with a 0.05% expense ratio matters far more at $1 million than it did at $100,000. Because the 0.55% annual fee differential on $1 million portfolio is $5,500 a year, compounded over the remaining decades of the portfolio's life. Where you hold bonds, whether in a taxable account versus a tax-advantaged account, becomes meaningful at this asset level because the tax inefficiency of taxable bonds compounds annually. And concentration risk from holding individual stocks rather than broad market indexing represents real dollars of potential loss on $1 million portfolio in a way that wasn't true at smaller balances. Change 5. Lifestyle creep risk peaks and tax planning takes over as the primary lever. The fifth change is actually 2 related changes that arrive at the same time. The first is that lifestyle creep becomes most dangerous once your portfolio crosses $1 million. The psychological logic is that if your wealth is generating $70,000 a year on its own, surely you can spend a bit more without consequence. Each individual upgrade looks affordable. a nicer car, a larger house, more travel, better restaurants. Each one of those, individually, is supportable by the portfolio's growth. The risk is that they compound just like the portfolio does. So a 5% annual increase in lifestyle eats up most of the portfolio's real return and leaves you with no actual progress despite generating large nominal growth. The second change happening simultaneously is that tax planning becomes the primary financial optimization lever. At $1 million of portfolio, much of it is likely in taxable brokerage accounts because tax advantage space has been fully utilized for years. Dividends, distributions, and realized gains in those accounts start producing meaningful annual tax bills. Per the 2026 federal long-term capital gains brackets, single filers with taxable income up to $49,450 pay 0% on long-term gains. Between $49,450 and $545,500 pay 15%, and above $545,500 pay 20%. For married filing jointly, the 0% bracket extends to $98,900. The 15% bracket runs to $613,700, and above that, it's 20%. High earners also face a 3.8% net investment income tax on top of the long-term capital gains rate when modified adjusted gross income exceeds $200,000 single or $250,000 married filing jointly. The reason these brackets matter is that strategic timing of realized gains, careful Roth conversions during low income years, tax loss harvesting, and asset location decisions, which is choosing which type of account holds which type of investment, can collectively save thousands of dollars a year in taxes for households at this asset level. Multiple analyses of tax-efficient withdrawal strategies suggest the cumulative difference between tax-aware and default withdrawal sequences can compound to substantial sums over a 30-year retirement, particularly for households where Roth conversion windows exist during the years between retirement and the start of required minimum distributions. The savings rate at this stage is essentially a rounding error compared to the tax efficiency lever. What people who have crossed $1 million actually do differently? There are a few specific behaviors that distinguish people who have crossed $1 million and are using the new math well from those who keep playing by the old rules. The first is that they stop tracking their net worth obsessively. The volatility at $1 million plus is large enough that monthly fluctuations can be tens of thousands of dollars. Checking the balance frequently leads to bad decisions. The right cadence is quarterly or annual review, with rebalancing once a year, not weekly portfolio analysis. The second behavior is that they pre-commit to a withdrawal strategy years before they actually retire, so the decision is mechanical rather than emotional when retirement arrives. Paul made his withdrawal plan 3 years before he retired, including how much would come from the taxable brokerage account first, how much from the traditional 401k starting at age 59 and a half, and how the Social Security claiming decision would interact with all of it. By the time he actually stopped working, the plan was just a question of executing what he'd already designed. The third behavior is that they get comfortable with being significantly wealthier than they look. My neighbor David, a Chinese-American first-generation immigrant who's well into 7 figures, drives a dented 2014 Honda Accord and lives in the same modest house he bought 20 years ago. The wealth doesn't show because David doesn't perform it. He just has it. People who have crossed $1 million and continue to live like they haven't tend to compound their wealth dramatically faster than people who have crossed $1 million and started showing it. Why the rule matters even before you cross. The $1 million rule isn't only useful for people who have already crossed the threshold. It's also useful for people who haven't, because it changes the destination they should be targeting. If you understand that $1 million represents the point at which your portfolio out-earns most jobs, doubles roughly every 10 years on its own, and provides real career optionality, You can stop thinking of it as a distant ceiling and start thinking of it as a structural milestone that fundamentally changes your relationship to money. Households that internalize the rule before they cross the threshold tend to reach it faster because the math suddenly becomes worth the discipline. The ones that don't often arrive at $1 million later than they could have, if they arrive at all, and miss the optionality the threshold was supposed to give them because they never recalibrated their lives to use it. Drop a comment with where you currently are relative to $1 million, and which of the 5 changes you think will matter most to you. I read every comment, and I'll reply to as many as I can. And if you want me to walk through the specific tax-efficient withdrawal sequence I'd recommend for someone with $1 million portfolio entering retirement, including the order to pull from taxable, traditional, and Roth accounts, hit subscribe, because that's the next video. I'll see you in the next one.